Welcome to part one of a three-part series all about credit scores and credit cards. Today we're taking a look at credit scores. This is not financial advice. You need a credit score and a credit card because credit cards are necessary for building your credit score. Your credit score is necessary because it lets you buy a house or in some cases a car, and your house is where you live. So our goal is to build a strong credit score with little to no debt, with the asterisk being hopefully a mortgage. Now, we can think of credit in general as a kaleidoscope. The credit bureau, those are the institutions that hold your credit information. You can think of that as the cardboard body of the kaleidoscope. The credit report are the pieces of information about you. That's those bits of glass there. The credit model is how the score is calculated, and you can think of that as those mirrored strips. And finally, the credit score is the final calculation made from this information, and that would be the image that we see through the peephole. So all of these work together to give us your credit worthiness. Now, there are a few things your credit score does not measure: your income, your wealth, your savings, and most importantly, your financial responsibility overall. It's very easy to have a strong credit score and negative financial practices. So just because you have a good score doesn't mean you're well off in any way. This is a list of accounts that contribute to your credit score. Most importantly, you have revolving accounts that allow you to carry a balance month to month if you wish, and installment loans, which start with a large initial balance that is paid off over time. In addition to that, there are things like collections. Unpaid medical debt can show up on your credit score eventually. However, that's pretty difficult, and there have been law changes in the recent past, as well as unpaid miscellaneous debt. Very common now are buy now, pay later agreements that can show up on your credit score, as well as closed accounts. So any account that's closed, whether it was closed in good standing or not, will continue to impact your credit score for between 7 and 10 years. Of all these accounts, I want you to stop and ask yourself which one is easy to acquire, long term, and requires you to pay no interest on debt if you don't want to. The answer is credit cards. The reason I say they're a necessary evil is because they're an excellent vehicle for building your credit score in a relatively short period of time. Now, there are two types of credit scores: FICO and VantageScore. FICO is used mostly for lending decisions, whereas VantageScore is used mostly for credit monitoring. The exact formulas for these scores are not published, and you should be aware that there are different scores and different models within each of these. For example, there's FICO 8 and FICO 9. However, generally, you just need to know your score for each. Your FICO score here starts at 300, goes up to 850. Same with VantageScore. However, you can see that the categories in between are a little bit different. Now, regarding score considerations, there's similar but different factors are considered. They're correlated, but not identical. However, the information does come from the same three sources, which are the credit bureaus I'll talk about in a little bit. Your Vantage score will often be higher than your FICO score, and VantageScore does not publish percentages for their categories. So where FICO says 35% of your score is based on your payment history, VantageScore doesn't tell you that, although it's estimated to be around 40%. So on this chart, you can see the correlated scoring considerations that are taken into account. First up is payment history. The only thing you need to know here is on time, every time, and there can be negative information that affects the payment history here. You want to avoid this if you can. Amounts owed. This is where credit utilization comes in, which I'll explain here in a second. All you need to know is that you need to keep your credit utilization between 1 and 10%, but you want to keep it above 1%. In addition to this, per card utilization is often considered, as well as the number of accounts that have running balances, installment loan balances, total cumulative debt. And one misconception I want to dispel is that you do not need to carry a balance on your credit card ever. Some people think that they need to carry a balance month to month. This is not true. You can use your card, generate the statement, and then pay it in full and not worry about gathering interest on your credit card. Now, utilization is simply your credit card balances divided by your total credit limit. So for example, if I have $10,000 of available credit and I spend $1,000 of that, my total utilization is 10%. Some utilization is important, but not a lot, and installment loans don't factor into utilization. A moment ago when I said that utilization was important, here's why. You can see in this chart from Credit Karma that people that don't use any of their credit actually have a much lower credit score than people that use 1 to 10%, and that's why that's the sweet spot. Next, we'll take a look at balances, and this is just the total balance on loans and credit cards. As I've already mentioned, this is your cumulative debt. It wants to make sure that your balance is decreasing over time, as well as taking a look at your current balance versus your original balance for those installment loans. It also looks at if you have any large outstanding credit card balances and any delinquent balances. Now, the available credit here is the amount of unused available credit across things like your credit card, your HELOC, and a personal line of credit. For these next ones, I've combined some of them because there's not a lot to say. Here we'll take a look at the age of your credit. So when we talk about the length of your credit history, the three things that are largely considered are the age of your oldest account. This is huge, very important. If you are young and you don't have a credit card and you're 18, you should open one. In addition to this, the average age of your accounts and the age of a specific account. Credit mix, this is types of accounts. For me, this is what I do. I have a mortgage and then several credit cards, and I get an A grade on my credit mixture. And then finally, age and type of credit. VantageScore considers your age and your type of accounts together instead of separately, like FICO does. Next, we'll take a look at new and recent credit. These are hard inquiries, which we'll talk about in a second. New accounts, the time since you last opened an account, the time since you last had an inquiry, as well as rate shopping, which is another question I'll answer here in a second. Your recent credit, similarly, those hard inquiries, new accounts, are you adding accounts, and any recent credit behavior. And to answer the question of what is a hard inquiry or a hard credit pull, that's when your score is queried by a potential lender and it has a slight negative impact for 12 months on your credit score. It remains on your score for 2 years. However, it only impacts your score for 12 months. And then rate shopping is when you do several hard inquiries within 45 days for a specific type of loan. So for example, if I query a car loan from multiple dealerships in 45 days, that's only going to show up as a single inquiry. It used to be 14 days. They've lengthened it, thankfully. And the only call out there is that credit card hard pulls are not rate shopped. So if you do a credit inquiry for a credit card, that's not going to be something that you can rate shop. Now, the 3 credit bureaus that I mentioned earlier are TransUnion, Equifax, and Experian. They hold all the information about you. Let's talk a little bit about security. This is something that you need to monitor monthly. There's a website called annualcreditreport.com that gives you an annual report from the US government. In addition to that, your credit union, bank, or even your credit card service will often offer monitoring and let you know if any new accounts have been opened. And I would highly recommend placing a freeze on each of your credit reports with the bureaus. What this does is it prevents anyone from opening a new account in your name. And the freeze prevents access to your credit report, but not changes in score. The few benefits of a strong credit score, and there are only a handful of them: lower interest rates on mortgages and cars. I would never recommend somebody buy a car on loan if they can avoid it. However, I understand for most people that's necessary now. In addition to that, you often get lower insurance rates, and it can affect your eligibility to rent in some cases. Let's talk about some common mistakes and misconceptions people have with their credit scores. Number one is taking out a loan to improve your credit score. This is generally a bad idea and should not be done. Opening a credit card can accomplish the same thing without putting you into debt. Next is opening too many accounts at once. Generally, you should limit account openings to 2 a year. I have myself done 3 or 4 in the past, and my credit score has dropped precipitously for a few months after that. One that I've already covered is that carrying a balance improves your credit score. It does not. You should pay your balance in full every month. This will stop you from incurring any sort of debt or penalty fees. Checking your own credit hurts your score. It doesn't. Some people think that closing a credit card immediately hurts their score. However, as we've already discussed, as long as the account was closed in good standing, it will continue to be a boon on your credit score for 7 to 10 years. Income does not affect your credit score, as we've already discussed. And debit cards do not build credit. Finally, the last misconception is that more credit cards automatically hurt your score. That's not true. So I hope this was an informative session for you. I'll be doing a part 2 on credit cards as well as a part 3 about my personal credit card system in the near future. Thank you for watching.